Tonight on Market Call, David Burrows is on the show. He's president and chief investment strategist at Barometer Capital Management, and he is taking your calls, emails, and tweets on North American large cap companies. Hello, I'm Catherine Murray. Welcome to Market Call tonight. You can call us toll free at 1-855-326-6266. You can also send us an email to marketcall@bnn.ca, or you can tweet us at marketcall. You can also upload a video question, film a quick question on your device, tag us in your post, or send us an email with the clips. And be sure to put video questions in the subject lines. Your questions can be answered by one of our guests during one of our shows. David, good to be with you tonight. Thanks for coming in.
Happy to be here.
Quite a bit to talk about, really. A lot of what we're seeing in the market is all macro-driven. So let's talk about that from a top-down perspective and what you care about and what you're focused in on here.
Great. So it's a really interesting market because, of course, after all of the things we've been through over the last number of years, everybody's peering around every corner for what could derail the market, what could take us down. And there's lots of jitters. It's interesting when you look at sentiment. The percentage of bullish advisors in the U.S. still is hovering around 20%, which is not much above the 30-year low that it hit a couple of months ago. So people are really cautious. And we've got Brexit coming up, and we've got concerns about China, and we've got concerns about other countries in Europe. And so there's no shortage of things to worry about. Yet here we are about 2.5% from the highs in the S&P 500. And so what we try to do at Barometer is we run a model that tracks the percentage of securities in a particular market that are performing well technically. And since February, we've seen a slow, steady improvement. And even in the last 10 days, as the market's been wobbling around, really virtually no damage to that indicator. So money is working its way into stocks, despite all of these big concerns.
Okay.
And I think that as we go through summer and some of these things clear, stocks can actually probably go a lot higher. Because when you look at the return that they're generating on their capital versus where you can go to buy a piece of fixed income, German 10-year bond at a negative yield, that risk premium you're getting paid as an investor is very significant. Not to mention, of course, the yield, which in many cases is double and triple what you could get in government debt. So I think the markets look pretty attractive. We just have to get through some of this noise in the market in the short run.
But David, I don't know why, in the absence of a better alternative, owning equities is necessarily the right choice. And I've had this conversation with a lot of people on BNN, and it comes down to, I think, how much capital you're willing to risk at that point in time. And given the fact that there are so many uncertainties, and everybody remembers very, very well the financial crisis, people don't want to be down 30% or 40% and have to recoup off of those levels.
Well, remember, the only way you can wind up down 30 to 40%
is if you sell.
Is if everybody, I won't say that, because we're very conscious of risk, right? We use stop losses on all of our positions. I'm very happy holding cash when the time is right. But the way that you get a 30 or 40% sell-off is when people are overinvested, many cases leveraged, and they are forced to unwind their positions.
Okay.
Like the banks, they were 40 times leveraged their money in 2008. The second half of the decline was a forced selling. Now, nobody is leveraged. In fact, hedge funds are under-levered right now. And in fact, they're very short the market. So there's no constituent that needs to be a seller in this market right now. Now, it's not to say there's not risks, but that's why the differential between the yield in a 10-year bond and the average stock in the market is as wide as it's been in 30 years. So you're getting paid an exceedingly large premium to buy risk, right? So you're supposed to make investments when you get paid to take risk. You're not supposed to worry about the news and the things that might get you emotionally distraught. So as it stands right now, there's all kinds of great companies better than the market with really strong balance sheets, very strong dividend growth, north of 10%, where you can get 2 or 3 times the dividend yield of a bond, and you're not taking on that balance sheet risk of buying a government bond at no yield.
So, but David, when you say that in this market right now, you're getting paid to take on risk, are you specifically really citing the dividend-paying companies then and the dividend growers?
Well, you can look at, for instance, the S&P 500. The average company in the S&P 500 is generating north of 6% cash flow yield on the value of its shares.
Okay.
And when you look at the yield on a 10-year bond at 1.6, the difference, 1.6 to 6 and change, is the premium you get paid for taking the risk to buy the stock versus buying the bond. In 2000, when stocks were expensive, people were happily buying stocks and taking a discounted cash flow yield to what they could get in government bonds because they were so confident shares would go up forever.
Well, that's because they were buying biotech and internet stocks.
Well, it's true, but the point is you can buy quickly growing companies today or stable growing companies and get paid well. Now, maybe it is that those are the companies that will do well. Maybe it is that the companies that are like bonds that will do well, like utilities and telcos and consumer staples companies. That's what worked in the 1950s when interest rates stayed between 2 and 3% for 15 years. People slowly went to buy those stable dividend-paying stocks. We have our foot in both camps right now. And I think if you could generate 10% dividend growth and get a yield of north of 3%, that's very attractive versus your alternative.
Yeah. All right. People would be happy. We're going to be back with David Burrows. He is President and Chief Investment Strategist at Barometer Capital Management, answering your questions about North American large cap companies. So definitely do give us a call. There's a lot going on in the marketplace. You can call us and get some thoughts and insights from David. We're at 1-855-326-6266.